Okay. I don't know how I'm going to last with this. Okay. Well, I'll run and get my markers. I'm going to give you guys a little homework problem. How about that? So, calculate the amount needed to be fully funded if an employee contributes $1,000 for 10 years. At market interest of 10%. All right, you can see why I need to get new markers. All right, that should take you a couple minutes. You don't actually need to do the math. Just lay out the equation. I'd like to see the whole equation. I'll be back. I don't.
Anyway, back to Susan Shears on. We should definitely go in and prove to her why she graded it wrong too. Just like back up. Yeah, well, that's what I did. Yeah, I argued with her email and like pointed out like, because she was like saying like multiple things were wrong, and I was like, I said in my paper, like, all these things. And the answer question I asked, various questions.
So this is what I don't want you guys to look in the book for. Yeah. So you don't have to use the sum. I mean, you can. That's just the reduced form. But I want you guys to be able to do this stuff in your sleep here. Present value, future value. This is just a simple future value calculation. That looks good, except you got the present value. So I kind of threw that to you in reverse. So everybody, what would we do here? Future value equals, you got $1,000 contribution. How do we calculate the first year's future value? Playing games with you here a little bit. Future value.
Times 1 plus the interest rate.
Times 1 plus the interest rate, right? Raised to the one's going to be 10, one's going to be 1, yeah, for the order. So this one would be to the 10th power since I asked for the 10, but it can go in any order. So 1,000 times 1 plus the interest rate, 10%, raised to the 10th power, plus 1,000 times 1.1 raised to the 9th power, plus 1,000 times 1.1 raised to the 1 power. You can burn up the calculator or whatever, do present value calculation, but that's going to give you the future value of this amount. Just kind of running it into the future. Yes?
Present value is what I was doing, right? Dividing the 1,000 by the 1 plus by the 10%. That's
present value, yeah. So all we're doing with the present value is kind of switching these two terms. If I just kind of look at this one in isolation and kind of forget about this, then the 1,000 is our present value. So we're bringing this over to here, right? So 1,000 equals the future value divided by 1 plus I raised to the 10th power. So future value going backwards and forwards is the same thing. Memorize that formula. Every OU business student, but especially finance, econ, and accounting, should be having present value, future value right off the top of their head. Greg and I have talked about that we might have a little test every class for every business student, and this would be in it. We want you guys to graduate knowing how to make that calculation. Fundamental of finance. Okay, so that was just kind of a little side job while I got my markers. Okay, so back to Penny Benny here. So, private pension plans have some elements to it. One of them I serve on. We have these ERISA laws, which was 1974. And the new thing that came down the pipeline with this is that OU has to be keeping an eye out or advising employees of information with their retirement funds. Not on a one-on-one basis necessarily, but at least keeping an eye on it. And so this was an additional regulatory burden that was placed on private organizations. And so I'm serving on the retirement committee, and we have Mariner Wealth Management, who Adam Hasty works for, by the way. You guys, how many of you know Hasty? I know a lot of you do. So that was his first job out of here, was with Mariner Wealth Management. And we're using that company that they kind of advise our retirement plans. And so that came out of this legislation that they're putting a little bit more burden on employers to do that. So we have the Pension Benefit Guarantee Corporation. Pension Benefit Guarantee Corporation. Penny Benny is the fund name. Penny Benny. And so this thing kind of works like FDIC. Places put in basically an insurance policy. They make contributions so that they will be, so that their particular pension will for sure have enough funds in the case of a default. So this is kind of like FDIC for pensions. Publications. Social Security, busted. Social Security, massive underfunding. The other thing that's unique with the public system is that it's a pay-as-you-go system. So pay as you go. It's more like pay as they go. money comes in and it goes out. Whereas with a private pension fund, they really have money that is invested in some sort of fund. They also have new employees that come in, so in that respect, it's kind of similar to security. So as a new person joins the union or joins the pension, then they're going to start contributing to it, and that'll add to the fund, right? So it's kind of similar in that nature, but there's actually some underlying investments. Whereas Social Security is just started off being 30 workers to every one worker, and we're down to like 3 workers to every one. 3 healthy workers, or I should say non-retirement age workers to every one up. All right, so what I'm doing is I'm just kind of chucking down that initial list. Maybe I should have put it up for starters, but remember we, back on Monday, looked at the breakdown of different types of non-bank finances. So I'm just running down the list here. Finance companies, they are virtually unregulated. At least compared to banks. What was the reason that we have so much regulation on banks compared to maybe a finance company? That's an important point to kind of remember. Because of the deposits, yeah. Because it's other people's money. Whereas if you're a finance company, it's your profits. You're just choosing to carry a note, so the government doesn't really care about you. They're not gonna. You do what you want. There are certain laws like loan sharking laws. You know, you can't go buy a car and have it be 100% interest or something. That'll get you thrown in jail. So there are some regulations, but for the most part, they don't pay attention to those too much. Okay, so sales companies. Consumer finance. All right, then we hit investment banks. Now we're getting into Wall Street here. So what do these investment banks do from what you've heard? What's some of the activities that they do? You're a big investment bank on Wall Street, you're Goldman Sachs. What's one of your primary things you're doing? Yeah, sell securities in the what? In the primary market, right? So you're bringing new companies. What's new one that just happened yesterday, or was it today that was out? Snapchat. How many Snapchatters we got out there? So, you know, that's kind of an interesting one from the stuff we've been doing with Skousen. How did they look for profit? They were a loser. They were estimating the value, or they're putting on the value at like 24, whatever, I guess it must be billion, right? 24 billion? Anybody know? Anybody follow the Snapchat? I think that's right. But they haven't ever made a profit even. So this is kind of similar to what happened with Facebook and some of these other tech companies. So what's going to likely happen is they'll get acquired and they'll figure out a way to monetize the Snapchat experience so that you get to see ads when you do it, or see ads more often. Do you guys see ads right now on Snapchat? Oh, you do. So, but whatever they've been doing, it hasn't worked for profitability. So, but it still was commanding that type of price. But I don't know, I didn't hear any more news on it. So is it coming out next week? I don't think it had come out yet, the IPO. Did it actually?
Yeah, it already did.
Did it hit? Increase in? So is it up right now compared to the IPO?
IPO was 17, it's at 24 now.
It's at 24, okay. So that'll be interesting to see what happens next week, if it stays up or if it crashes. Okay, so investment banks assist in the sale. assist in the sale of securities. So I don't know, do you know who carried Snapchat? Was it Goldman Sachs or somebody, or who the investment bank was? I didn't hear that. Okay, so with bonds, they're going to advise on maturity and interest payments. Advise on maturity and interest. So if there's a new offering of corporate bonds, what are they priced at? How long should they be? Because they're not going to sell very good if the price of the bond doesn't match the risk that they're taking on. So they're going to analyze, they're going to do all their due diligence and all the analysis of the company to see what they think they should go for, what kind of risk investors are taking on. And then stocks with Snapchat, for instance, they're going to advise on basically the price, the IPO, the initial public offering. Sometimes those stocks crash after they're offered. Sometimes, apparently Snapchat's doing pretty good then. They're up. Wanted to put example Snapchat. So you said it was at 17, Matt?
The IPO was, yeah.
And then now they're at 24?
Yeah, somewhere.
After like 2 days? So is the investment bank firm going, oh crap? They left a little bit of money on the table, potentially. Now, I don't even remember where I've read this before, but they say the investment bank would like to see it go up, but not that much, because the investment bank guaranteed some of this back to Snapchat. And so if they lost out on some of the actual value, then they might have didn't get as much money. Same thing with the Snapchat owners. If they cut loose, they guaranteed 17, they didn't get all this upside on the initial public offering either. So like a block of them that get offered out. So it's not always perfect, and there's risk on the investment bank as well as on the people who are jumping on them. Any other comments, questions on that? All right, so these guys are regulated by the SEC. And then we've got, they also do these a securities broker and or dealer. You guys probably talked about that in one of Greg's classes before. What's the difference between a broker and a dealer? I suspect, I don't know, I'm not for sure. I used to have my real estate broker's license. So if you're a real estate company and you're brokering a deal, what are you doing? Connecting buyer and seller. Do you actually buy the house yourself? No. If you're a car dealer, a local car lot, do you own the cars on the lot? Yeah. So that's the difference between a broker-dealer. The investment bank, whatever company it is, if it's Merrill Lynch or whatever, they broker deals and they hold holdings themselves. So they have them like parked on the lot, so to speak. So they hold securities as well. So with a broker, this is strictly buyer and seller, and they make their money off option. A dealer does some of that too, but also holds securities. And so they're going to be more in a buy low, sell high mindset on top of a commission. Buy low, sell high. And I'll put that in quotes because we all know we can sell short too. But so the dealer's holding on, brokers working deals between. So a brokerage firm is all of these. If you call yourself a brokerage firm, they are in general acting as broker, dealer, investment bank. All right, we're almost to the fun one I've been waiting to get to here. Got one more boring one to go on. It's not that boring, really, but mutual funds. I know some of you guys have seen this in other places. Mutual funds. Talk about this one, personal financing. Mutual fund. What are mutually funding? How does that one work? Yeah, you are mutually funding companies before. What is the mutual fund?
People that pool their money together in a common fund.
Good. I heard both spots. Yes, Paige. Pooling money together in a common fund, is that what you said?
Yes.
Yes. And that's about you and Chisholm were doing about the same time. All right, so individual investors pooling their money together as one so that they can have a larger portfolio. So pooling resources of many small investors. Pooling resources of many small investors to own shares of multiple companies. All right, so another weird one is a sovereign wealth fund. Sovereign wealth fund. So over in the Middle East, a lot of Saudi Arabia money, a lot of rich oil money. They create funds too and will own assets. And one of their estimates was $3 trillion. So this can a lot of times be rich oil money from the Middle East. Not always, they can be from anywhere, but. So this type of fund usually brings up some issues of national security, perhaps. They have a large amount of assets, which could lead to some instability. So just a couple notes on that. So concerns of national security. Due to size and can cause market instability. Can cause market instability. Most of these funds, the mutual funds and the sovereign wealth fund, are open-end funds. So this is most common. It is redeemable anytime. Anytime the market's open. So you can buy in and out of the fund. You can pick up the phone, call your broker, and pick up some shares, and you're in. You can call your broker and say, sell, 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 I'm out. So it's an open-ended fund. Closed-end funds have a fixed number of shares. A closed-end fund has a fixed number of shares. All right. Hedge funds. Now we're talking Wall Street here. Hedge fund. Okay, so these are typically fat cats. They have to have a net worth of at least $1 million. And that's usually the amount that they're putting in as well. So minimum investment of usually at least $1 million, greater than or equal to $1 million. Less than or equal to 99 investors. So 99 people, each putting in at least $1 million. So these are all high net worth individuals. And it's also a long-term commitment. You're not going in and out. A long-term commitment. So when they have the hedge fund agreement, they're saying, hey, we're putting a hedge fund together. Everybody's kicking in $1 million. We want to get in. Well, they don't want you getting out too fast. So you're going to have kind of minimum lengths of time. And they can also have amounts on when they can sell and how. So if you get into bed with a hedge fund, you better know what you're getting into. They are not regulated much at all. That sounds bad, doesn't it? We don't have the government police. Why don't we regulate hedge funds very much? Yeah. Right, they can handle themselves. Again, the effort to protect the public isn't there. You're a fat cat, put in your money, shut up if you got screwed. You should have known better, or you shouldn't have put your money in. Right? So less of an effort, so there's not much regulation with them. All right, so I'm going to run through a little hedge fund scenario here. So a hedge fund structure. How a hedge fund works is there's usually a management fee, let's say a 2% management fee. This is the kind of the norm. And a 20% profit share. Okay, so we got Russ Capital Fund. Kind of has a nice ring to it, doesn't it? LP. And we all have, kind of do this asset and liability thing like we've done before. We've got $100 million kicked in, and we've got a 30% partner, a 30% partner, a 10% partner, right? So they can have different shares of ownership, whatever they are. And then finally, we've got the managing partner, Russ. Russ has a 10% share. He forms Russ Capital Management. And that's probably like a little LLC. So Russ Capital Management is an owner along with the other investors. And my job is to manage the fund. So I am the general partner. These guys are limited partners. What are they limited to? The percent that they have. That's the most that they could lose. Whereas Russ over here, we're trusting him with all the operations. If he does a bonehead thing and gets sued for $1 million, he's a general partner. So he could wipe out the whole hedge fund and further. So the general partner takes on all of the liability of the operations, whereas the limited partners are limited to their investment. Okay, so Russ Capital Management puts that money to work, and in his first year, makes $20 million. Not too bad. So let's say this is 2015. In 2016, we end up having a grow the fund to 120 million. What's going to come out of it? How much gets split between the partners? So if I grew the fund without any more contributions, right? I grew the fund to 120 million. What's the management fee? 2%. 2% of the 120, the full fund value. Now what they really do is they come up with some sort of average over the time. So 2% management fee would come out of that. And that is based on the amount of holdings that you have. And so that brings us down to, let's say, 117.8. And then the profit share. 20% of the 20 million profit goes to Russ Capital Management. I like that. Okay, yeah.
Oh, so the 20% profit share goes to the general partner, or it's split between the limited partner?
No, just to the general. This is me for doing a good job. You did a good job. 20 million is pretty good. 20%. So I'm going to get 20% of the profit made that year. So off of the 117 comes 3.56 million. Not bad. Can go off to lunch for that. And I'm left with 114.24 million now of profit. Now this 14 million is going to go back to the profit, the owners, of which I'm 10% too. Okay? That's how these deals are structured typically. Yeah?
Did you hypothetically get the 117.8 or that the 2% over?
That was the 2% of the 17 point, or the, let's see, did I get that off the average? Off the average growth. So it grew from 100 to 120 from time period 1 to time period 2. The average of the two was 110.
Okay.
So the 2%, take the average of the holdings. So we had 110 over the course of the year, 110 million times the 2%. Okay, so that's management fee versus operations versus profit share. Yes.
So okay, you said the 114.24 goes back with all the people that are in it.
Yeah.
So the fund always stays at 100 million.
No, it does not have to be distributed. That'd be another operational thing. So we're not going to necessarily divvy out the 14 million. We can let it ride. But Russ got paid the 2% real hard cash out of the fund because I got to pay the bills. I got an electricity bill with all those computers running and chart analysis with all my hedge fund stuff, right? So that's really literally what that's supposed to be is for my payroll, my employees, all of that stuff. The company that I'm running get 2% management fee. And then this is in here more as an incentive to do good with the fund, right? Because otherwise, these guys are just the fat cats living in Tahiti on the beach, and they just, oh, I trust that Russ guy. He's good. He's been doing stuff. I'm a member of a hedge fund. Give me a cigar and another margarita. Right? So something like that. So they're just kicking back. So they want Russ to have incentive to make money with this thing too, so that Russ has some decent skin in the game as well. Okay. All right, that's probably enough said on that one. Any other questions on that? That gives you at least the idea of a hedge fund setup. The textbook will fill in a few more blanks. This is probably more detailed than what the textbook goes into, but they talk about the management fee and stuff. Private equity fund. That's an important one. That's been really growing a lot lately too. A private equity fund is completely private equity. Like literally, it's usually one rich family that has all of their money going in investments that are long-term. So this is not publicly traded. They are typically buying companies or real estate for long-term growth. And this is where you've heard of venture capital. If you've got a new startup company, you're out seeking a venture capitalist, that very well might be a private equity firm, or it could be. And then you've got leveraged buyouts, capital buyouts. George of Wall Street. So this is the leveraged buyout. You guys remember Mitt Romney? He's mentioned in this. You know, remember the name of his company? Bain Capital. So he was a millionaire that specialized in private equity and doing buyouts. All right. The last one is Fannie Mae, Freddie Mac. Let me just write that down, and then I know I'm moving a little long, and I got to go talk with the president here in a second. Yes, I better get my act together. But government, and this is what we're talking about with Allison. Government-sponsored enterprise. The GSE, government-sponsored enterprise, Freddie Mac, Ginnie Mac, Federal Home Loan Mortgage. So these are known as quasi-government entities. Allison Thanks. Bad. So the government bailouts, all the stuff we've talked about with the financial crisis, those have a little government bailout in them. They're technically private companies with government backing, is the way to think about sponsored enterprises. All right, that will call it today. That'll be it. So your test is up there. It's just a single chapter, so I've been kind of doing, if it's a double chapter, extending the time, but I kept it at 60 minutes for this one as well. So prepare yourself. Have a good weekend.